Points in as well. Mitesh Thakkar has been speaking with us. Vijay, morning, still holding with the range-bound theory for the rest of this month, or do you think things may turn in either direction?
Well, I think the month is so far down, to expect anything dramatic would be, I think, unlikely because we still have very few trading days, and Monday is also a market holiday. So I think we'll be range bound, but the matter is clear that the market's found a base. It has got spooked due to inflation fears. Last 2 weeks, inflation fears literally sank the bank stocks. Some amount of composure and comfort has returned to the market. So I think we wouldn't go down much, but I don't think there's any upside in the next few days of trading.
It's very event-heavy going into the first part of 2010, though, Vijay. First there will be earnings, then there will be an RBI meet, and shortly after that the budget. Is there a chance the range for the market can get readjusted in the early part of 2010?
I feel we will have a good rally in January 2010 because we've had some good news coming in, in the shape of a strong GDP growth we had, 7.9%. Then we had very good industrial growth. Credit offtake has picked up. All these things the markets totally ignored. If you see the last 2 months, from about October 10th to now, the market's been in a very narrow range. The markets never forget. They always come back and revisit realities. And in the US also, we have been getting some good economic news. So I think if the earnings are not too bad, we should try and reclaim those 5,200 levels sometime in January.
Vijay, hi, morning. What about the banks then? Yesterday we saw it was a good day for them. Some of them really anchored the market, so to speak. Do you think the rate hike fears are now put behind us, at least for the shorter term?
Yeah, those fears were almost phobias, We had, people anxious that the RBI governor was meeting the finance minister. I'm told that's a mandatory meeting both of those gentlemen have every month or even more often than that. And the market got panic about it. But I think we will not get a rate hike in India. We will get a CRR hike, probably about 50 basis points going to the third week of January when the normal credit policy is announced. That will immobilize about 27,000 crores of bank funds, which is not that much compared to the liquidity sloshing around with banks right now. So I think the markets had to react, but I think it overreacted a bit. And now the market's realizing that because last 2 days we have seen an overperformance of bank stocks, and the inflation is there, but curtailing liquidity is not the solution for this inflation. That's very clear. So I think the banks have got spooked, but right now they look quite attractive to me.
Mitesh, we were talking. Vijay, if the call is the market can actually scale up by the time we step into next year, would you be buying right now, or do you think that pricing point will come to you rather than buying at 4,900?
Well, it's a good question. It's become sectoral, What most of us as fund managers are doing is we are actively looking at new realities, new winners. I'll give you a case in point. All of us started getting overweight in IT stocks. All of us started getting overweight in pharma stocks about a month back. So it's a natural process. It's not as if we are all sitting on 80% cash and suddenly, bingo, we see some 4940 and put all our money. We are mixing. Wherever we see, people getting hysterical, like metals, for example, yesterday, we are outing. So there's a lot of churning going on, as you can see in the high lows, for example. We had a tremendous figure of about 133 highs to 4 lows yesterday, which is a very strong confirmation of an uptrend. So we are doing that all the time, but incrementally we are buying more and more into pharma stocks, IT stocks, construction stocks, and so forth.
What do you hear in Delhi about the trading hours extension debate, Vijay? We know the BSE brokers have made their voice heard, but is Delhi likely to step in?
Oh, Delhi never keeps quiet in India. That's a problem. I think there will be some change in the timing. I think 9 is a bit too vicious for, and now clearly the arguments are getting a bit political. If you see the big ones versus the small ones, I think the small brokers have managed to change the language of the discussion into the big boys teaming up with the exchange to finish off the small boys, etc. So there could be some indirect intervention probably to a relaxation at 9 o'clock at least.
Well, okay. What about the entire metal space? I mean, you did speak about that trading vigor that we saw in yesterday's trade, but fundamentally some of these stocks, are looking well placed, especially some of them like Nalco that have just hiked product prices. Anything from non-ferrous that you like, Nalco, Hindalco, anything of that?
Yeah, we have been buying Hindustan Zinc for a long time. We have made about 100% gains in the last 6 months. Aluminium, we've been a bit more cautious. The thing about metals is conventional economics of the stock markets indicates that metals and commodities normally lead a bull market, and they did that. They've been, I believe, the best performing sector or thereabouts in this last 9 months of the bull market. Going forward, I think these Indian metal stocks have overrun the LME prices. If you see the correlation, which means that they've been beaten up too much. So going forward, I think we are using these huge uptrends to slightly trim our metal exposure. We did that even with sale yesterday afternoon. And we are going more into value adds, focusing our attention more on the BHELs and LNTs and IVRCLs and the Thermaxes of the world, the value adds who use metals.
The drag for the index, though, has been the entire oil and gas space. Would you be comfortable buying anything from that vertical now between ONGC or Reliance or even some of the oil marketing companies?
No, because it's very unclear. I mean, one is sort of able to make a call on global energy prices. I go with the common herd that it will be probably up to 84, 85 levels by the end of 2010. But how does that get reflect in the bottom lines of ONGC, the oil marketers and the refiners, is a very big question because the government is forever talking about fiddling the oil policy. We don't know which way the fiddling will go, whether diesel will get deregulated, whether LPG will get deregulated, will bonds will be issued, cash will be issued, how much will be the hit on ONGC, Oil India. I mean, it's all up for political and bureaucratic discussion. So what does one do in that type of environment? The refiners make a clearer picture. If one wanted to at all take an exposure, the refiners will see strengthening of margins from the current low levels. But compared to the Nifty weightage, our portfolios are very underweight in oil and energy counters.